All right, we're doing well here, right? Getting towards the end of the day on Monday at ALM. Keep that energy up, right? Caffeine. I saw lots of caffeine out there. So we called this session Follow the Money, and that's a colloquialism that seems to ring true whether you're doing, true crime detective investigations or panels at advertising conferences, because my thesis on naming it Follow the Money is, look, at conferences like this, you can do a lot of chin wagging about a lot of issues, but if you really want to parse which trends are real and where is the industry likely to go, I think it's a pretty good idea to follow seasoned investors in terms of where they're putting major dollars in terms of their investments and acquisitions. And today we have a very seasoned and accomplished group of very knowledgeable, capable, and active investors. So we've got two. When I talked to David about constructing this panel, we said let's mix it up when we reprise this investor panel. Private equity, so we've got a large private equity, a mid-sized private equity, and a strategic. And so I want to get into sort of your views on this marketplace. And just as a level set, we've got companies that are, firms that have a spectrum of investments in this sector. Lucy, talk to me about your portfolio of companies in the sector.
Sure. So I'm at Providence, and we're a sector specialist firm. Everything pretty much that we do is in the media, telecom, and technology space. So ad tech is a perfect area for us to invest behind. And it's funny that this panel is called Follow the Money, because that's how we invest in media. So we're actually looking, where's the consumer money going? Where are the consumer eyeballs going? And that really dictates for us where we're making investments. And we saw really early on the shifting dollars from cable, from newspapers and traditional media, where Providence for almost 40 years has been investing, to digital. And we thought, okay, that should be great. We should invest there. And we started looking at companies, and many people in this room have been in this space for a long time. And you saw, yeah, that sounded great, but hard for a lot of really big advertisers to put money behind, different platforms and digital advertising, because it was so early. And that's really what led us to invest in Double Verify, and really with this thesis that advertisers wanted to invest in digital, but they were having a hard time feeling comfortable with that investment. And then through Double Verify, we saw, okay, there's a lot of shifting dollars towards social advertising, and that led us to invest in Smartly.io. So that's sort of, for us, a lot of what's led us to the investments we have now. And we can talk about where we're investing next, but we see a lot through our portfolio companies. What are some of those trends, where are the consumers going, and where are the dollars going?
And Laura, you too, longtime media investor. Tell us a little bit about your portfolio.
Yeah, that's right. So similar to Providence, Shamrock Capital, we are sector focused. So all we do is invest in media, entertainment, do a lot within marketing and advertising. For us, it's really where is their growth, where is the industry going? And then there's very different business models that maybe are different ways that we can play on those trends. So within our portfolio, we have agencies, we have technology and software businesses, we have media companies, we have content production businesses, talent management businesses. We're really touching the entire ecosystem when you think about our industry. Big growth orientation. So again, we're really thinking thematically about where the industry is going and then where we can add value. So a couple of examples, just to name a few, current investments include Adweek, EDO, VidMob, Ad Results Media, Branded Cities. We were previously investors in companies like Screen Vision, W Promote. So that gives you a little bit of a flavor of some of the companies that we invest in. And similar to Providence, again, very sector focused, but a slightly different stage. So we will come in as a later stage growth or as more of a growth oriented buyout investor. So we also can be both minority and majority in terms of our stage of investment.
Great. Sheila, you are a digital media company, Spotify, a public company in the sector that is the champion and my favorite for all audio. You have a subscription model, but you've been doing a lot of late in terms of building your ad-based businesses. You've been extremely busy over the last few years doing, by my count, close to like a dozen deals with names like Megaphone, The Ringer, Anchor, Chartable, and half a dozen others. How do you come to this space and your sort of thesis and your deal activity?
Well, we have been very busy at Spotify across many of the names that you mentioned, but if I sort of step back and say, well, what are we really doing from a corporate development perspective? We're trying to bring the best inorganic options to the table to accelerate Spotify strategies, whether that be in content, in advertising, or in platform capabilities. And we've really made acquisitions across the whole digital ecosystem, from tools to content to ad networks, analytics, and even generative AI capabilities. So really across the whole ecosystem. And advertising in particular, our investments have been around really trying to bring forward the podcast industry to become a true digital, scalable, targetable, and measurable format. That is a journey that we are well on our way to for anyone who's in the podcast industry. But I think that what we're seeing happening in podcasts is really what's happening throughout all of audio, becoming a much more measurable, targetable medium. And we continue to grow our ad business on that basis.
I want to cover areas where we talk about investing and deal making, but on the investing side, private equity in this realm, you're both sector-focused private equity, and it's my experience that it's very, very different than what private equity used to be, in particular in the metal bending industries where, largely you talked about financial engineering, putting a lot of debt on these businesses, cutting costs, and then, squeezing the cash flows and eventually, selling it off. This is so different in media. Give us a sense of how you add value to these companies, whether you're helping them with organic growth, inorganic growth, strategy, sometimes client work. What are the ways in which, once you've made an investment, you assist those companies in their growth paths?
I'm happy to start. So, fortunately, in this higher interest rate environment, our focus has not been around, putting a lot of debt on businesses and really looking for companies that just generate cash flow. We do like companies that also generate cash flow. That's ideal. But our big focus is really growth orientation. And so, companies, I would say typically that we're investing behind are growing, well north of double digits. Some are, more on a higher end spectrum, but I would say, by and large, they're double digit growers. And to your point, right, it's not there definitely are some firms and some strategies that are more focused on, putting a bunch of debt on the business. But the thing that we really like to do is find companies that are, growing organically, that are disrupting the market. And I think, part of what led us to digital was the fact that the market is growing, right? You don't have to just lever companies up. So that's a big part of it, is finding companies that we think have really sustainable growth opportunities. And then, as you said, Terry, M&A is a huge focus for us at Providence. Just to put some numbers on it, in our last two funds, we had 44 platform companies, and we did 240 add-on acquisitions with those companies. Wow. So, and some of them are, tiny sort of acqui-hires. Some are geographic expansions. Some are, more consolidation type strategies. I would say most companies are, using a variety of those different approaches, but that's a really big focus for us and something we work really closely with our companies on.
And you certainly don't need to use leverage like in the old days in order to juice your returns. You're probably one of your biggest returns, Double Verify, was very minimal leverage and had a great return for you.
No, absolutely. And, we honestly, in higher growth sectors like, ad tech or digital, we like to put less leverage on because it gives us more flexibility. So our average leverage is just around 4 times on our portfolio companies. So, and that's across all industries, but I think gives a sense for it, helps with a little bit of the discipline to have it up front, but it's not the thing that's really driving the returns.
The other thing I would add to that too, growth has always been in our DNA in terms of how we drive returns for our investors, but I think as the private equity industry matures, it's that much more critical. You're seeing a sea change in private equity where there's a lot of capital out there. Most processes or most valuations are sort of very efficient, so it's hard to find that diamond in the rough where you're sort of getting a value on the way in. And so when you think about how we are driving returns for our investors, it's that much harder to assume you're going to get multiple expansion or you're going to drive it all through financial engineering. So you're seeing across the industry a lot more investment in what's called value creation, where you're thinking day one in that investment about how do we put the building blocks in place over those next 3 or 4 years to really drive growth in the business. M&A is a tool for that. Certainly M&A is an accelerant. It might fill capability gaps or just help you get scale faster. But organically, you also want to be thinking about how do you pick the right spots from a market perspective, and then how do you accelerate growth through the operations and the building blocks along the way.
Right.
And so I think it's becoming a more critical tool in private equity when you think about driving returns, especially in a higher interest rate environment and with the maturity and the amount of capital out there. And then there's a lot of different ways you can achieve that, right? When you think about the stage of business and what those tools are along the way.
Right. Sheila, unlike Lucy and Laura, you're not exiting your investments. You're living with them. How do you gauge whether an acquisition worked or not? How do you gauge performance?
Well, that is such a critical difference between financial private equity acquisitions versus strategics, because we all have a financial plan when we do an acquisition, but for us, we also have a strategic plan. And how much of the value comes from the financial results in the first 3 to 5 years versus how much of the value comes from the strategic benefit that this brings. Every deal is different, but the great thing about the strategic agenda is that it probably has a longer time horizon, which gives you more time to realize the results. It may be harder to actually attribute the results of a strategic acquisition, but when you hit it right, you're going to get the benefits for a much longer term, and you're not going to be hemmed in by an investment horizon that may restrict some of the opportunity in the private equity side.
And maybe if I can just jump in, on the flip side, like when we're talking on the private equity side, I don't know what you do at Shamrock, but we always have a 100-day plan, because the view is, all right, you have 3 to 5 years, sometimes when we hold investment for 6, 7 years, you gotta really run fast early on. I mean, I think a lot of the key work happens in those first couple years, and so we think in that sort of 100-day planning cycle, and some companies really love that. Some companies really embrace that, and they say, okay, there's the urgency, I gotta move fast. Now, you're right, on the flip side, you might lose out on that. All right, what am I gonna build for 10 years out, 15 years out? That's sort of a little bit of the tension, but we try and at least think, all right, longer term, while having some of that urgency earlier on in the hold cycle.
Yeah, well, we do the same thing. I think probably the most important thing for those who are thinking about different capital sources is just understanding the differences, because I think it's just really, there's pros and cons to private equity versus strategic, and where the company is in their own life cycle might dictate what the right fit is at the time. We always try and suss that out if somebody's looking at both, because the paths are very, very different.
Yes.
It's just a different value prop, right? There might be a ton of strategic value and opportunities that can be unlocked by a strategic investor that a private equity investor can't provide. But on the flip side, there's clear focus and execution and a lot of alignment around incentives when you think about the private equity model. So I think we always also think about what stage of evolution is the business and what are they looking for, because if they want the strategic path and we're a little bit of a fallback, that's not really the right alignment and vision. If they ultimately want to go to a strategic, it might just be they're not ready yet, then private equity could be a really good bridge to that, and then they'd be ready for someone like Sheila. So, sorry, I know you were going to jump in.
Oh, well, I was just going to say the 100-day plan is essential. Whoever the buyer is, they need a 100-day plan, because if you lose time at the beginning, it's going to cost you big time as you actually try to reap whether financial or strategic outcomes. Just knowing exactly what you want to do and having alignment with the business leaders on both the buy and sell side when you go into it, totally critical.
Also, I find it matters the distinction between where the investors are and where the management team is, because there are some amazing case studies of private equity-backed companies which get multiple kicks at the can, right? Because they get a partial exit when they cut their deal with private equity, but then they get the capital to go to town and really build out the TAM and maybe make some acquisitions and build it into a really scaled companies. There are some folks and clients in the room here that have done private equity deals that made more money on the second go-around than the first go-around, and will likely make even more on the third, on the ultimate exit, because you get to ride with big capital that helps you strive higher. One of the things that when I introduce private equity folks to entrepreneurs in the ecosystem, they're almost universally surprised by the level of sophistication. Because gone are the days when you had private equity generalists that competed with now what is largely commoditized capital, to your point, Laura. And so, this is a renowned for being a very fragmented, complex ecosystem. How do you all get up to speed in terms of the trends, which companies to pursue for investments? How do you parse that to make these investment decisions?
Yeah, there's a couple of things we do. I mean, we take a very thematic approach. So even before we're making a specific investment, most likely we've spent a lot of time. We actually staff internally like a deal that we're working on, different themes and trends that we're excited about to educate ourselves, understand the entire landscape, who the players are, what might be sort of interesting ways that we can play those trends, and we want to get to know the businesses early. So we're not meeting them for the first time when there is that capital need. We might be meeting them a few years ahead of time and watching that journey along the way.
Right.
The other thing we do, which I think you were touching on briefly with how Smartly came together, is we also leverage our portfolio. So one of the benefits of being sector focused and having a lot of investments in the same industry that do different things is they also often know what are really interesting new technology applications or business models that are evolving that maybe are looking for capital, and they have a front row seat as a client or a partner to those businesses, and that perspective is invaluable. Right. So we did that with W Promote, which used to be a portfolio company of ours. They're an agency in the space. They were using a lot of technology applications. They used DDO, they used VidMob, Smartly was another platform that they used. Yep. And so it gives us confidence and a better understanding of how that's working in the marketplace so that we're not starting from scratch and we're not having to educate ourselves sort of day one when we're looking at an opportunity.
And I would agree with everything Laura said and add, the industry executives, whether it's at our portfolio companies, as you said, or people that come into these events or other industry events, it's so valuable because we like to be really deep in our spaces, but we're ultimately not operators. And so having that sort of operator perspective is incredibly valuable.
And I guess, Sheila, you came from the ad world, so doing things in advertising from the standpoint of a subscription technology platform is a world you're comfortable with, obviously.
Well, Spotify has always been a dual revenue company, and it's actually been a pretty essential ingredient to our success of having an ad-supported freemium model has allowed us to become the largest audio streaming service in the world. And we continue to build and invest in both sides of that business. But when I think about overall, the opportunities that we pursue for acquisition, they stem from what are our overall strategies for the company. And so everything fits into those grooves. We're not typically going and acquiring a business to get us into something that isn't squarely in the bullseye of the company strategy. Yeah. And advertising has been a part of that, central part of that recently.
One of the big themes today is the fact that this industry is going through so much change. We're at an inflection point on a variety of parameters. And I'm curious, from your standpoint, since you're looking to underwrite these major investments, and you've got these massive exogenous changes, whether it be cookie deprecation coming this year or AI and its impacts, how do you basically convince your boards, in the case of strategics, or your investment committees, in the case of private equity, about making the right bets? Because you've all made bets in and around AI. You've made investments in AI. You guys have, Double Verify has made acquisitions in AI. It seems like it's a major impact with a lot of unknowns. How do you get comfortable?
I mean, I think generally for us, in terms of how do you get comfortable with making these investments in the space. I mean, I think what's so interesting about ad tech and digital advertising is how big the market is, but with that, there is gonna be a level of, potential for disruption, right? There are gonna be a lot of players. And so I think for us, there are certain things that need to be true, right? Established business models. Yes, there has to be a growth orientation, but I think, like I was saying before, some level of profitability that needs to be there. So I think there are some things, barriers to entry, some stickiness that, we can invest behind. I think as it relates to AI, I'd be curious what Sheila and Laura think. I mean, we're certainly making investments through, most of our portfolio companies. Mm-hmm. They're all from a code development standpoint, leveraging generative AI. We have a number of companies, Smartly.io, who's here, spoke earlier around generative AI, so they're building out capabilities. Is this gonna be the year where Providence does a AI standalone investment? I'm not sure, never say never. If you're a company that, fits this profile, still feel free to reach out, but I think it might be a little bit too early for us, right? Because we're really looking for, that established business plan, pricing model, and I think, frankly, for us, it's probably gonna be a little bit too early, but that doesn't mean we can, ignore it, either for our portfolio companies or, what's gonna happen in 3 years, 5 years, because the market's changing so quickly.
Right. Right.
I think for us, the build, buy, partner framework has been really, really, really critical around AI. because obviously there's been a huge amount of investment over many years to get OpenAI and the like to the level of LLM capability that they even have, and moving beyond that. For us, it's been really instrumental to say, what are the things that we absolutely need to own and control our own destiny? What are the things that are going to grow to such a scale that they're going to be provided across the ecosystem and something where we should be comfortable commercially partnering? And what are the things that we could actually grow ourselves because we have such deep proprietary data? And so the acquisition that we made of a company named Sonantic allowed us to create our own voice, which we've used to power the Spotify AI DJ. It's had incredible take-up with users, it's driven consumption, amazing KPIs, improving economics for those users. And it's just the beginning of us now having a one-to-one, direct, individualized, interactive relationship with a voice that we own. So we will continue to partner with all kinds of companies across generative AI, but that's a use case that we really wanted to own.
Yeah. We think of AI a little differently. I think it's because we invest across such a breadth of business models. So we have agencies or research firms or consultancies or media companies where we need to think about AI, we need to see what third-party tools are out there, we need to stay ahead of the curve because there's risk and there's actually opportunity to differentiate if you get ahead of it.
Yep.
But right now, I'd say on those businesses, it's a lot about efficiencies, automation, trying to help augment the services that they're providing to their clients today versus transformational to their revenue model. Maybe over time, there's new revenue applications and new ways to incorporate that more.
Right.
There's also businesses on the software side where machine learning and AI are core to what they do and have been a part of what they're doing for a while. And this whole conversation that's now reached sort of broader culture around AI plays in their favor, and it's something that they were doing all along.
Yep.
And so for us, we need to stay ahead of it. Each business is a little bit unique in terms of what the relevance is and the applications to them. We've sort of canvassed our entire portfolio in terms of saying what are the risks and opportunity to each, but it looks pretty different depending upon what the company does.
Right. Right, but forcing them to make that calculus and lay that out is probably pretty logical. 2023 was a dismal year for deal making and investing, a variety of factors, macro uncertainties, rates, et cetera. I'm curious, our experience has been dialogue has really picked up in the last 6 to 8 weeks. I'm curious your sense, whether it's your actual pipeline or your gut tell you about 2024 from a deal making and investing standpoint.
Our pipeline is full. I mean, I think it'll be busy. I think the big question, and you probably saw this, and Sheila, you also probably saw this from last year, the activity might be up, but what actually gets done? And I think people need to go into this year with that expectation of, you know, if I want to get a transaction done, it just might not happen because the likelihood, there are just so many more risks and challenges and uncertainties out there. Right. Now, I think relative to last year, with, you know, rates at least doesn't feel like they're going up, you know, at least being stable and maybe starting to come down. I do think that makes things a little bit easier to get done. I mean, there's a lot of private equity-backed businesses out there that need to, you know, have a timeline to get a transaction done. You know, there are a lot of companies that have been waiting on the sidelines, right, to do a bigger transaction. And I think there's a lot of consolidation opportunity, right? I mean, if we just look at, you know, some of the companies here, right, there are probably some that make sense over time to come together, and that's for us, you know, a great opportunity.
Yep.
Yeah, I'm optimistic about 24. I mean, the bar is low compared to 23 because, like you said, it was a pretty quiet year. You had the sort of the macro uncertainty, interest rate environment. You had the writers' strikes. It's just a bunch of stuff that was sort of all happening at the same time that created a lot of uncertainty. And so companies that didn't necessarily need to do something waited or didn't have the visibility to go out and tell their story. So I think on that basis, we're going to see more activity in 24. But while our pipeline is more active, it's hard to know if like truly buyer and seller expectations are on the same page. Rates are more stable, but they're still high relative to where they've been the last few years, not over a longer term period, but in recent history. And so I think all of that will still create a little bit more of a subdued environment than if you look back at like 21 or the beginning of 22.
Sheila, are we busy?
I would say, I think the ice is melting, but it's melting really slowly. I mean, in our space, where our prospects tend to be growth-oriented, technology-oriented companies, we're still living with a lot of companies that were valued back in 2021, so that's still a mismatch. I also think a lot of companies like us have this amazing, like, super fit feeling right now. We've gone through a year of really introspection, some trimming, prioritization, focus, efficiency, whatever the word might be to typify the environment. But that means the bar is really high to spend time and money on a new initiative. And so that combined with a valuation environment, I think there's the bar is really high to get deals done in the near term.
Well, hopefully as strategic activity picks up and as the industry matures, more and more private equity investments become part of the realm. My advice to you, follow the money. Thank you very much, Lucy, Laura, Sheila.